Welcome back to today's Explainer. We are peeling back the flashy headlines to uncover the real financial reality of the luxury watch market in 2026. For the past couple of years, I'm sure your social feeds have been absolutely flooded with wild stories of wristwatches doubling, tripling, or even quadrupling in value overnight. But today, we're cutting through all that noise. We're digging into the hard data to see what's actually happening under the crystal. Before we dive into the numbers, we've got to address the massive elephant in the horology room. Are watches actually a good investment in 2026? Or is this hype running completely out of time? Have we genuinely entered an era where a mechanical watch acts as a rock-solid alternative asset? Or is this just a huge bubble fueled by viral trends? Well, let's find out. Here is how we're going to break this all down today. We'll start with the allure of horology. Then we'll hit the waitlist reality, dive into secondary market dynamics, analyze true investment returns, and wrap up with the hidden costs. All right, part one, the allure of horology. The Knight Frank Wealth Report recently highlighted something truly fascinating. Ultra-high net worth individuals are currently allocating a massive 20% of their portfolios to tangible passion assets like luxury watches. We aren't just talking about pocket change here. This is a deliberate, massive transfer of wealth into physical, wearable items. And within that 20%, watches have carved out a seriously dominant position. Now, as most of you already know, this entire alternative asset class is overwhelmingly anchored by the big three: Rolex, Patek Philippe, and Audemars Piguet. These brands haven't just popped up overnight. They've spent decades, sometimes over a century, building the kind of emotional capital that drives intense, almost irrational demand. They aren't just selling advice to tell time, right? They are selling a narrative of pure prestige and uncompromising heritage. When you talk about investing in watches, you're basically talking about the sheer gravity generated by these three titans. And that creates a ton of tension in the community. Take this comment from a Hodinkee member, which brilliantly hits the nail on the head. There is a fierce, ongoing philosophical tug-of-war happening right now. On one side, you have pure passion collectors who cherish the mechanical mastery and the history. And on the other, you have speculators who are entirely hype-driven, perfectly willing to pay 1,000% markup just for the logo printed on the dial. Which brings us to part two, the waitlist reality. To really understand these insane markups, you have to look at economic scarcity. Patek Philippe is the ultimate example here. They artificially cap their total yearly production at just 60,000 pieces worldwide. Think about that for a second. In a global economy with literally millions of millionaires, only 60,000 new Patek Philippe watches enter the market each year. That heavily controlled supply is the absolute bedrock of why these things appreciate. Because supply is completely choked off, you could easily be sitting on an authorized dealer's waitlist for 5 to 8 years just to get a shot at buying a highly coveted model like a Nautilus. You literally cannot just walk into a boutique with a suitcase full of cash and walk out with the watch you want. You have to play the game, build a relationship, establish a massive purchase history, and then you wait. And this extreme scarcity scales across the entire big three. Want a Rolex Daytona? You're looking at a minimum 5-year wait. Dreaming of an Audemars Piguet Royal Oak? That could walk you out for 48 to 96 months. This dynamic is exactly what fuels the secondary market. If you have the cash today and you want the watch on your wrist tomorrow, you have to bypass retail entirely and pay whatever the gray market demands. Let's transition into part three, secondary market dynamics. Because nobody wants to wait a decade for a watch, buyers absolutely flood the secondary market. Just look at the transaction data from Bob's Watches. The GMT Master 2 experienced a jaw-dropping 506% appreciation between 2010 and 2025. That means a watch that cost $3,400 15 years ago is now changing hands for north of $20,000. It's exactly numbers like these that convince the mainstream public that watches are a foolproof, zero-risk investment. But listen, this market is incredibly volatile. While the stretch from 2010 to 2022 saw a viral-driven, massive boom in pricing, peaking at an average Rolex price of over $17,000, the broader market faced a sobering 5.1% correction in 2024. That wild 2022 peak was driven by a perfect storm of low interest rates, stimulus checks, and social media hype. When the macroeconomic climate shifted, the watch market proved it definitely wasn't immune to gravity. During that correction, even the absolute heavyweight's blood value. Patek Philippe dropped 6.5% and Audemars Piguet fell 7.4%. So yeah, watches do not just go up forever. For the guys who bought at the absolute top in 2022, hoping for a quick flip, that correction completely wiped out their gains. It's a harsh reminder that trying to time the market is incredibly difficult, even with the most prestigious brands on earth.
That leads us perfectly into part 4, true investment returns.
It's time for a reality check. When you compare luxury watches to traditional yielding investments side by side, the narrative changes fast. Watches are highly illiquid and offer zero passive yield. Meanwhile, the S&P 500 historically returns about 10.3%, and even Bleep's USD savings vaults offer a steady 3.83% APY, without forcing you to lock up your cash for a decade. A stock portfolio or a high-yield savings account compounds automatically in the background while you sleep. A watch, it just sits there. You only realize a return on a watch on the exact day you manage to find a buyer willing to pay your asking price.
And finally, part 5, the hidden costs.
The headline-grabbing stories of watches tripling in value almost always ignore the devastating hidden costs of ownership. A watch sitting in a safe does not compound interest, it bleeds profit. You're looking at massive 20 to 30% auction buyer's fees, seller commissions around 10 to 15%, pre-owned dealer margins of up to 30%, mandatory annual insurance taking 1 to 2% of the value, and expensive mechanical servicing that can easily run you from 350 to over 1,200 euros. If your watch appreciates by 20% over 5 years, but you get hit with a 15% dealer margin to sell it, plus 5 years of insurance, plus a 900 euro service bill, your actual net return could literally be negative. The online influencers never show you those receipts. Plus, if you're bypassing the authorized dealers, you are walking straight into an absolute minefield. There is a massive skill barrier here, because you're competing against 30 to 40 million counterfeit watches that flood the global market every single year, costing the industry $3 to $4 billion. And these aren't your cheap street corner knockoffs anymore. These are super fakes that routinely fool experienced dealers. Unless you have the deep technical expertise to authenticate dial printing, movement finishing, and period-correct parts, playing the secondary market as an investor is wildly dangerous. So, as we wrap up today's explainer, I want to leave you with a thought. Once you strip away the hype of guaranteed returns and you genuinely account for the auction fees, the brutal wait lists, the service costs, and the market volatility, are you truly an investor, or are you just a passionate collector buying what you love? The data tells us that while spectacular returns are definitely possible with the big three, they require deep expertise, flawless timing, and significant capital. For the rest of us, maybe a watch should just be a watch, a beautiful piece of mechanical art to be worn and enjoyed, not just a line item on a balance sheet. Thanks so much for joining me on this deep dive into the 2026 watch market. See you next time.